Hello everyone, thanks for checking out my video. Earnings season is heating up. We have Tesla, Netflix, Bank of America, Goldman Sachs reporting their earnings this week. Meanwhile, a series of mixed economic data appeared to confirm another interest rate hike by the Federal Reserve, which dampened the investors' mood after the big US banks launched a stronger than expected start to corporate earnings. Well, things are getting trickier day by day as the market and investors continue to be in a confused state. But fret not, let's discuss them all in this video. The S&P 500 and Nasdaq clinched their fourth positive week in 5. Dow Jones, however, notched its fourth straight positive week. A couple of economic reports were out last week, which are likely the reasons behind the daily wild intraday swings. Let's quickly dissect them. So basically, investors assessed back-to-back reports last week. First, it was the CPI data. The headline CPI came in lower than expected at 5% versus 5.2% estimate. Core CPI, which excludes volatile food and energy prices, edged higher to 5.6%. These two numbers shows that yes, inflation is cooling, but it is also very sticky. And then on Wednesday, we had the March Producer Price Index, aka PPI, a measure of prices paid by companies, declining by 0.5% from the previous month. Economists had anticipated a slight gain, and this PPI, which is considered a leading indicator of consumer inflation, gives investors further confidence that inflation is indeed easing. On Friday, big US banks namely JP Morgan, Citigroup and Wells Fargo reported stronger than expected earnings. However, a weak and disappointing retail sales data offset the excitement and dented enthusiasm. Alright, despite an eventful week, the stock market didn't really have big weekly moves, but there were huge daily and intraday swings. In terms of market outlook, the macro picture remains fluid, while earnings season get ramped up over the next few weeks. Therefore, investors should expect more volatility and wild swings. Okay, speaking of earnings, analysts are expecting S&P 500 earnings to fall more than 5% in the first quarter, mainly due to the persistent inflation and higher interest rates. Some are even saying that the bar has never been set lower. Personally, I think beating these estimates may not be hard to achieve since the barrel is low. What is more important right now is the forecast and guidance that will be given by the companies. I mean, it is widely expected that the economy will be slower in the next few quarters, or at least till the end of the year. But we don't know what kind of impact it will have on businesses and also the extent of it. So pay attention to the guidance from the companies, alright? Let's see if they can induce confidence in the shareholders and stock market. Personally, as I am a Tesla bull, I will be very interested in Tesla's earnings report, especially when it reported a record Q1 deliveries earlier this month, thanks to big price cuts and new US EV credits. But yes, it is also because of the various price cuts, investors, including myself, will be interested to find out how these discounts will affect their profit margins, which had already been starting to slide last year. In fact, there were actually more price cuts announced about 2 or 3 days ago as this video was recorded in Europe, Singapore and Israel, which will only be reflected in the next quarter's earnings. And for info, Tesla is reporting its earnings on Wednesday. Okay, at this junction, I just wanted to caution that Tesla is a high growth and volatile stock. A lot of good stuff has been baked into the stock, so any surprise to the earnings can mean huge movement on the earnings days and will likely spill over to the next few days or even weeks and months. Moving over to the technical analysis segment, as usual, starting things off with SPY, which looks really interesting to me. Check out this green dotted uptrend line. SPY has been floating along this trend line for the last 10 trading days. That's about 2 weeks. SPY is like knocking on the door trying to enter and push above the trend line. Anyway, let's make this clear. As the earnings get underway, if SPY can break above this trend line, it's bullish. Because other than resuming its uptrend, it will also break the high of 2023, which was set back in February this year, at around 417. When that happens, we have a very high chance of filling that tiny gap between 419 and 420. Then, bulls will want to bring SPY up to retest August 2022's high at around 426. A few green candles above this level will signal a bullish breakout, and we could start to head towards the Fibonacci extension level at 434. by then, or maybe even before that, when February 2023's high gets broken decisively, and if you are still a bear, I would think you should reconsider your position. Not financial advice, of course. On the other hand, if big companies throwing some stinkers for their earnings or forecasts in the next couple of weeks, and SPY gets rejected by the uptrend line, there are 3 gaps at the bottom which will likely be filled. We have 2 small gaps at 404 and 401. The bigger gap sits at 396 to 398. And when all of these gaps get filled, bulls will have to be careful because at that level, it means SPY has broken below the 400 psychological level as well as the 50 moving average, which currently sits at 401. But that being said, bulls need not panic as long as SPY can hold above the 200 moving average at 391 and the 38.2 Fibonacci retracement level at 389. But if let's say SPY goes below this level, then yes, bulls should panic a little and bears should rejoice, because the next target will be the downtrend line below 380. Honestly, to achieve this level or even to break below the 200 moving average at 391, it will be an uphill task for the bears. With this, I hope it's clearer in terms of my view, at least for the technical aspect. Basically, it's leaning bullish with the SPY holding up, and bears have a lot of work to do to turn the direction into a bearish trend. And if things change, I will update it here, so do remember to subscribe to my channel if you haven't. Let's now move over to Apple. Apple is still on this monster run that started since January 2023, but just based on last week's movement, there's nothing much to highlight for Apple. Basically, it is still hovering at the 160 range, below the red dotted downtrend line, with both bears and bulls not gaining further momentum in the last 1 week. But if we are talking about this year, then yes, bulls are leading the way for Apple. And for Apple to be really bullish, it needs to break and close above the trend line decisively. When that happens, we will likely feel the gap at the top, which sits at 170. At that point, I think the MACD will have a bullish cross as well. That will be a good sign because as you can see, bears had their bearish cross recently, but if it crosses back up at the bullish zone, it means bears are losing their selling power. To add on, last week's pullback to 160 has cooled down the RSI indicator, which provides Apple more room to go up from this point. Okay, that's for the bull thesis, and as they say, nothing is guaranteed. So let's say if bears start to gain momentum and Apple gets rejected at current level or at the downtrend line, the first target for the bears will be the gap at 158 to 159. When that happens, we may just continue to go down to retest the first Fibonacci retracement level at 156. This area should offer some support and bounce. But if it doesn't, the next target for the bears would be the 50 moving average at 155. But again, for bears to gain full control, it's an uphill task because it needs to break the 38.2% Fibonacci level at 150 and the 200 moving average at 149. When we hit this level, then yes, bears would have taken over control and could bring it further down to fill the gap at 146 to 147. At this stage, at least in the near term, say leading up to its earnings day on 4th of May, I don't really see any reason for Apple to go close to 150 level. If anything, it could just be a slight or small pullback from the current level of 165. Well, I could be wrong, and I wish I am wrong so that I can pick up more Apple shares below 150. Moving over to Tesla, which will report earnings this Wednesday. The stock is basically moving in a tight range since February this year, and because of this, the put options that I have been profiting. More on that later. Anyway, as Tesla continues to consolidate within this range, the Bollinger Band is getting tighter. And if you have been following my videos, you will know that whenever the B band gets narrowed, it is usually followed by a huge move, which can be either side. As a recap, the last time we had this tight Bollinger Band was in early March, and it was followed by a huge move downwards, as Tesla fell from 190 plus to 160-ish. That was a 30 point to the downside. As mentioned, the move after a squeeze in B band can go either direction. Therefore, I think we can expect 20 to 30 points of upside or downside. Tesla is at 185 now, and that means either we will get to 160 range or we hit above 200. Just to make things even more interesting, both the RSI and MACD are showing indecision in the market as they are pretty flat. It's sort of telling us that a huge move is incoming. But a huge caveat, nothing is guaranteed, but I am quite sure Wednesday earnings will be a catalyst. Okay, on the upside, if Tesla really make a 20 points movement upwards, that means we will easily reclaim the 23.6 Fibonacci level and the 50 moving average at around 190 to 192. And to be honest, even if Tesla moves above 200, there is nothing much to cheer about because we had hit this range a few times earlier this year. What will really get the bulls excited and to turn this Tesla trend into a bullish trend will be to reclaim the 200 moving average at 214 as well as to break above the recent high of 217. When that happens, it will officially put us back into this consolidation zone that took place between May to July 2022. At this area, we can expect some form of resistance at the top end of the consolidation zone, which is around 255. Just to note, there is also a gap here pending to be filled, and this will also serve as a resistance area. Alright, a quick one on the support challenge. Sadly, last week we did not achieve any of the following tasks or challenge. So this week I really hope to garner your support as I continue to share everything for free, yes, at no cost. Have been doing this for more than a year, any form of support would be much appreciated. So the very first and easiest way of showing support is simply by tapping that like button. We achieved 36 likes last week, and thank you to the 36 of you who did it. This week, let's try again to hit more than 45 likes. That's the maximum number of likes I have ever received for my videos. The second way to show support is via the coffee link in the description box and comment section below. You may buy me a coffee or bubble tea at $3. The last way to show your support would be to sign up for a Referral account if you have not done so. It basically works like other low-cost brokerage platforms such as Momo and Tiger. You just have to deposit say $1 and you and I will get free shares. Okay, back to Tesla's TA. Let's say Tesla offered disappointing results and poor forecast for the rest of the year and the stock decides to tank again. 20 to 30 points downside will bring us to 150s to 160s range. 159 should offer some form of support, but not really a strong one in my opinion. The strongest support should come in at the gap area, which is between 146 to 154, with the 61.8 Fibonacci level sitting here as well. Though nothing is guaranteed, are you able to imagine Tesla falling from 185 to 160s or even 150s range? Let me know in the comment section below. Finally, we have Google. Google's bullish run doesn't seem to want to stop. It's retesting this 108 level again, and it even closed above it last Friday. So for bulls, they would want to see Google print another maybe 2 green candles for the breakout to 110 or even 114 area. At the very moment, buyers seem to be stepping in every time bears try to push it down, as you can see from the MACD. Whenever it wants to have a bearish cross, it made a U-turn and remains green. On the other hand, it is also noteworthy to highlight that there is a bearish divergence on the RSI. But this means nothing yet. Come this week, watch if Google gets rejected at this 108 area and whether the MACD will start to form a bearish cross. This is how you look for confirmation. And if let's say there is a pullback this week, the first support is at 105. A stronger support is at 100 to 101 area, where the 200 moving average is, as well as the psychological level. If Google breaks below this area, then bears is gaining control because that will mean we are falling back below this dotted uptrend line again. Moving over to the options trade segment, this week I don't have much update also as I am waiting for my 2 contracts to expire. One of them is Tesla. Do you recall earlier I mentioned that Tesla has been moving sideways? And at this point, this particular trade will likely expire worthless this coming Friday because of the sideways movement. I have another open Tesla put contract that I sold and it is also looking good right now. But of course, if Tesla drops 30 points this week, then it could be a different story. Anyway, the other contract that I sold and it's expiring this Friday is this covered call contract on Google. I have not closed this contract as Google has been on a massive run and some form of pullback is likely to come. But I don't know whether will it be in time before my contract expires or whether will it even touch 105 again in the near term. Therefore, I will play by ear this week to see how this contract pans out. Will update in my next video. Alright, my end thoughts for this video. Remember last week I shared that I am bearishly bullish? In case you don't know what this means, or in case viewers think that by being both bearish and bullish is equivalent to not saying anything, well, let me explain it. This bearishly bullish view means that in the near term, I am leaning bullish as you can see that the market has been holding up for the last few weeks or even months. and technical charts of the major indices are painting a slight bullish picture too. But here's the but, despite the bullishness in me, there is still this little bit of bearish side of me that is telling me to remain cautious given the fact that interest rate is still high and inflation is still sticky. I personally believe this will continue to take a toll on the economy and stock market. I just don't know the extent of it. I mean, I'm not saying the stock market will hit a new low. We could just have another, say, 5 to 10% pullback, and then we are off to a new bull run. Nobody knows actually. Anyway, my point is not to predict the extent of the next pullback. I just thought to clear things up with regard to my current view of the market. And in case you think that by having these both bearish and bullish views is a way to allow me to flip my words in any direction that the market moves, well, all I can say is you may not understand the market well enough. The best example is the intraday movements displayed by the market in the last 1 or 2 weeks. Basically, almost on a daily basis, the market fell off the cliff at the start of the trading hours, and then it staged a comeback at the end of the day, and vice versa. This shows that the market is in a confused state, and neither bears and bulls are having the upper hand right now. And this fits quite well with my thesis or view of bearishly bullish. To add on to this, I mean there is no need to be 100% bullish or bearish. Why force somebody to take an extreme bullish or bearish stand? It can be a case of 60 to 70% bullish while retaining 30 to 40% of bearishness. Okay, too much sharing of my stand, but I thought to clear things up so that viewers do not get confused or misinterpret my current take of the market. But of course, I could be wrong. So anyway, let's now cover some of my other thoughts. My general views and thoughts remain pretty much the same. Core inflation remains sticky or rather stubbornly high based on the latest CPI report. And personally, I think this number can reverse or go up anytime in the next couple of months. Even if it does not, it is likely because Fed is going to raise the interest rate more and keep it high for a long period of time. And when the Fed fund rate remains high, we may then have to watch how it will impact the economy, say in the next 6 to 9 months. Okay, the too long didn't read version is, when inflation cools, recession fears rise. Just to share, even Fed officials are predicting a mild recession this year based on the FOMC meeting minutes that was released last week. And the odds of a May rate hike actually increased to 80%. The final too long didn't read version of my thoughts is that recession and Fed rate hikes are not a great combination for the stock market. But on this, I also would like to share that this does not mean I am not adding anything to my long-term portfolio. Yes, the volatile market swings make it tricky for investors to add stocks. But then again, I have repeated countless times that DCA is always the best thing to do for long-term and simple-minded investors. Yeah, you heard me. A lot of times it is us who make things complicated, which result to loss of money in the stock market. Alright, that's all for this video. Could you share with me your thoughts on the current market? Please also remember to tap the like button before you exit this video. I will see you in the next one. Thank you.